Sachar Pradyuman of Cirrus Research. The latest issue of the briefing report is just out. This report summarizes market patterns. We look at performance results, but we're putting it in context of how equity portfolios are positioning. The title, AI Earnings Fuel Bounce as Cyclicals Drive a Broader Market. The performance in May was quite strong. You'll notice that across the board. What we did have especially was a very large cap biased bounce. Some of this was driven by the sell-off of April. It was a sharp correction. However, the earnings that came through in some of the technology companies really drove a recovery. That said, it was quite broad-based. What you'll notice is not only did larger caps do well, you had the classic Mag 7, FANG, Bitcoin strategies come back to life. So speculation came back. In addition to that, we also saw a CapEx theme work as infrastructure came back strongly as well. Moral story is that what we've got is a crowded situation that really stabilized in April with a correction. As a result, our crowded model came back to neutral. It really opens the door for trending markets to continue to run, especially in a world of easy credit. To drill down a little further on the sort of infrastructure industrial story, take a look at the sort of divide year to date between technology, as we call it, speculative growth versus the deep cyclicals. What you'll notice is that within the smaller cap arena, you've got a very strong industrials run. This has been going on for a couple of years. Notice the smaller technology stocks actually lost ground year to date. In large cap, it's sort of reversed, but the important thing to notice here is that as much as the technology sector is dominant, thanks to those, the Mag 7 effectively, or Mag 5, depending on what you want to call it, what you'll notice, however, is that the absolute returns on the deep cyclicals are also quite strong. Again, some of this is driven by the fundamental movements in industrial spending. So we like this space. It continues to work. It's working across the market, less noticed in large cap or large cap growth benchmarks. And then finally, as a follow through to this, the active performance portfolios, they continue to work well. There's one glaring exception, and that is large cap growth. Our aggressive growth model in the large cap section, that's this bar here, basically shows a runaway performance move, and a lot of that is for everything we've been talking AI. And so active excesses are fairly constructive, especially in the smaller cap growth arena, partly because the hurdle rates are lower. And in the value side, very little difference between the smaller and the larger value results. They all seem to be they all seem to be contributing favorably. Take a look at the report. As always, happy to take your questions. Thank you.